investment possible. It pays exactly 0 interest, generates no dividends, and just to keep it from being stolen, you have to spend millions on armed guards and heavy steel doors. That is gold. In 1971, the global financial system officially abandoned this metal as a form of currency. With a single stroke of a pen, President Richard Nixon severed the US dollar's tie to gold. Yet, half a century later, the United States continues to guard thousands of tons of it, roughly 2.5% of the entire world supply, inside the heavily fortified walls of Fort Knox. It is a glaring contradiction. The US government commits vast capital and security to hoard an asset that hasn't backed its currency in decades, and the United States isn't acting alone. Central banks around the globe are currently sitting on 40,000 tons of the metal. Today, gold makes up 17% of all foreign reserves on Earth. This chart of central bank gold purchases shows a dramatic shift. A historically flat average has spiked to over 1,000 tons a year. Splitting the data by region, Western powers aren't driving this trend. This new volume is entirely driven by emerging markets. The smartest, most resourced institutional investors on the planet are aggressively hoarding an expensive physical rock. They are using it for a purpose the general public doesn't fully grasp. For legacy powers like the United States and nations of the Euro area, holding on to massive historical stockpiles is a matter of defensive strategy. If these established institutions were to suddenly liquidate their gold to free up capital, global market prices would collapse. That shockwave would threaten the solvency of major bullion banks and erode trust in the creditworthiness of Western currencies. To understand the new buying frenzy, we need to look past why nations hold gold and examine exactly what they are trading. Central banks trade a highly specific institutional standard. This is the LBMA Good Delivery 400-ounce bar. It weighs 12.4 kilograms and is refined to 99.5% purity. At this scale, the 400-ounce bar represents the foundational physical unit of institutional trust and national wealth. For emerging market buyers like China, Turkey, and Poland, the motivation to stockpile these bars changed rapidly and permanently in 2022. That year, the US and its allies froze $300 billion of the Russian central bank's foreign reserves, almost entirely overnight. This exposed a mechanical vulnerability in the global financial system. Holding foreign reserves in dollars or euros means you don't possess physical money. You hold digital ledger entries inside Western custodian banks. This requires ongoing permission of the custodian nation for funds to remain accessible. The fallout from the Russian sanctions demonstrated that digital reserves can be instantly weaponized or erased when geopolitical alignments shift. The fragility of a digital ledger sits in stark contrast to the absolute autonomy of possessing physical gold within your own sovereign borders. Gold is the only universally recognized reserve asset that operates with zero counterparty risk. It doesn't rely on a foreign government's promise or permission to hold its value. A physical bar locked in a domestic vault is mathematically and politically immune to foreign defaults, international sanctions, or account freezes. Middle powers are acting on this realization. Institutions like the National Bank of Poland are systematically pulling their assets out of the digital system and moving them safely into physical vaults. These nations aren't accumulating physical metals for a financial profit. They are buying them as a defensive mechanism against the weaponized US dollar. This gold represents a physical premium on sovereignty, the cost of guaranteeing a nation's absolute independence.